Well, good. Wow. This crowd quiets easily. That's great. Good morning. Morning, everyone. More or less, we're all with it. Okay. My name is David Spalding. I'm the Raisbeck Endowed Dean of the College of Business at Iowa State, and it is my pleasure to welcome you for what is always one of the highlights of the fall term for us, the annual Robert Stafford lecture. We've had a really exciting fall, and with all the great stuff that's going on in the college, it was going to be hard to keep going at that high level with the other great announcements and discussions we've had in this room and elsewhere in the building, but having one of our own now on the SEC Commission back to give this lecture makes this another very special day for us here in a fall of special events. So before we begin, I'd like to recognize the organization that really makes this lecture possible and the individual who's remembered by the name of the lecture. Ames National Corporation is a multi-bank holding company with more than $1.36 billion in assets. Ames National started this lecture series in celebration of their 100 years of service to the Ames community, and also to honor the career contributions of Robert Stafford, a former president and chairman of the board who spent decades with First National Bank and the Ames National Corporation. Bob Stafford enrolled at Iowa State in 1942, but then left school and became a decorated pilot for the Army Air Corps during World War II. He returned to Iowa State, but our business program was more limited in those days. He took every course we had, and then went on and finished his degree at Northwestern University. In his career, he served for many years as the head of First National Bank of Ames and Ames National Corporation. He was a longtime friend and volunteer with Iowa State and received the ISU Honorary Alumni Award in 2007. Bob passed away in 2009, but through Ames National's sponsorship of this lecture, we proudly pay tribute to his legacy of service to his community. I'd also like to thank Ames National Corporation, First National Bank, your staff and board of directors for investing in our students. Ames National has had a scholarship on campus for a number of years. Earlier this year, First National Bank created a scholarship endowment in support of our students as well. We're pleased to have Taylor Pettit, the recipient of the Ames National Corporation Scholarship, and Grant Keast, the recipient of the First National Bank Scholarship, join us for this lecture. Taylor and Grant, are you here? Congratulations, thank you. And again, my thanks to the board and the officers and executives of the bank who are here with us today. And if they'd please stand so we can thank them for their generosity to Iowa State. So today we're truly honored to have as our guest speaker, Commissioner Michael S. Piwowar. Michael Piwowar was appointed to the United States Securities and Exchange Commission in 2013 and served as acting chairman of the commission from January 23rd, 2017 to May 4th, 2017. I have to say, sitting here in Ames, it was fun to read in the Wall Street Journal as he stepped into that role and truly served as an active interim. As we're learning here on the Iowa State campus with active interim Ben Allen, it is possible for an interim to continue to move an organization forward, and Mike certainly did that in his time as acting chairman. Prior to the SEC, he was the Republican chief economist for the U.S. Senate Committee on Banking, Housing, and Urban Affairs, and the lead Republican economist on the 4 SEC-related titles of the DoddFrank Act, and the Jobs Act. During the financial crisis and its immediate aftermath, Commissioner Piwowar served as a senior economist at the President's Council of Economic Advisors in both the George W. Bush and Barack Obama administrations. His first tenure as the SEC was in the Office of Economic Analysis as a visiting academic scholar while he was on leave from Iowa State University, and as a senior financial economist. Dr. Piwowar was an assistant professor of finance at our college, where he focused his research on market microstructure and taught undergraduate and graduate courses in corporate finance and investments. The title of his lecture today is The Future of Financial Regulation. Please join me in welcoming our 2017 Stafford lecturer, Michael Piwowar.
Thank you. Thank you very much. Thank you. Thank you. Thanks. Thank you, Dean Spalding. Can everybody hear me in the back? We think we got the volume set right. Thank you very much. As Dean Spalding mentioned, I am an SEC commissioner, which means three things. One, if you're here to hear me talk about college football, you're going to be sorely disappointed. It's the other SEC, and the other SEC, second, means that I'm from the government. I'm here to help. All right, good. Not everybody laughs when I say that, so that's good. And third, because I am a government official, I do have to do a disclaimer which says that all the views I express are my own, do not necessarily reflect the views of anyone else at the commission or any of my fellow commissioners. So what that does with that disclaimer, it frees me up to be frank and have an honest discussion about sort of my views on not only the future of financial regulation, which is the title of this talk, but I'm actually going to start and do a little bit of a quick history to get us to where we are today and where we're going to, I see us where we're going to be moving forward. I came into town the night before last, spent all day yesterday with Professor Dark. He had me going from 7:30 in the morning till 10:30 last night. We were out at the Research Park, Small Business Development Center, the Papa John folks, the SciBiz folks, all those other folks out there, seeing great opportunities for students and entrepreneurs in the local area and everything that they're doing there. Went to Kingland to see the folks over there, the amazing work that they're doing, and the cool internship opportunities they have for students where you can go over for 2 hours at a time and then come and get your work done back here on campus. Where else are we? We met with the National Association of Black Accountants, local chapter, talked about careers in accounting and thinking about public service and those sorts of things. Met with the Student Investment Group last night. Got to listen to some of their pitches. It's amazing what undergraduate students are doing nowadays. I think back to my days as an undergraduate, and I would have been at Mug Night last night, but these students were actually doing really cool things. And so had a great visit to campus. It's great to be back. The college is moving in the right direction. The university is moving in the right direction, and you all are part of something special here. So I said the talk of my title is The Future of Regulation. I'm going to start a little bit, go in the past. What I'm going to do is talk for maybe like 20, 30 minutes, and then what I want to do is save the last 15 minutes for questions, because I can talk to you about what I think you think is important, but it's really the questions that I get from folks. Last night with the Student Investment Group, we stayed here late. There was just a ton of really good questions about the SEC, about regulation, about where the government's going. Happy to answer any of those questions, right? So let's start from about 9 years ago, fall of 2008, right? We had the start of what became the global financial crisis, right? The biggest financial crisis since the Great Depression. And we had, it was almost exactly 9 years ago, we had the failure of Lehman Brothers. Actually, in March of 2008, we had the failure of Bear Stearns, an investment bank been around for a long time. The failure of Lehman Brothers. We had the two government-sponsored enterprises, Fannie Mae and Freddie Mac, taken into conservatorship by the government, basically a bailout. And they're still in conservatorship to this day because of the government can't figure out what to do with them. We had AIG go bankrupt. We had a government bailout of the creditors to AIG. The Reserve Primary Fund broke the buck. And there were a number of other financial institutions that were at risk of failing, not only U.S. institutions, but global institutions. In the immediate aftermath, or while this was going on, there was a lot of emergency things that the government did. That included bailouts that didn't make too many people happy, but that's what the government decided to do. The Federal Reserve stepped in, opened up a lot of liquidity facilities to keep certain markets running, like the money markets and some of the securitization markets. And there were a number of other emergency actions that were taken over the months of the financial crisis. Once the dust settled, the administration decided to move towards financial regulatory reform, and that culminated in July of 2010 in what's called the DoddFrank Act, which was mentioned. I was working on the Hill at that time. I was at the White House during the financial crisis and then moved to work on Capitol Hill during what then became DoddFrank. And what was DoddFrank? Well, it's 2,319 pages long. And what did it do? Well, many of the provisions in DoddFrank were intended or are intended to solve some of the problems that people saw that led to the financial crisis, to either A, prevent the next crisis, or B, when we get into another financial crisis, making the resolution of these complex financial institutions much easier and limiting the spillover effects into the broader economy. So I chose my words very carefully about Dodd-Frank. I said many of the provisions, and I said well-intended to address the crisis that are there, right? So many of the provisions were intended to address the crisis, not all. As the President's Chief of Staff at the time, Rahm Emanuel, said, why let a crisis go to waste, right? Well, he said it, right? And so what happened was Dodd-Frank not only became a way to resolve some of the issues with the financial crisis, but in order to get votes in the House and in the Senate, a lot of members of Congress were able to slip things into Dodd-Frank that had nothing to do with the financial crisis. And we're left with some of those provisions today, and I'll talk about those as things that we move forward. So some of the things that were in Dodd-Frank had nothing to do with the financial crisis. There's a phrase in Washington, D.C. Called a Christmas tree bill, where it's a bill that is like a Christmas tree that's going to get through, and because it's going to get through, why don't we just start tacking on more and more ornaments on this Christmas tree? Because there's always so many Christmas trees bills that get through Congress, and so tack on a bunch of unrelated stuff. So that's one bucket of thing in Dodd-Frank. The other part about the phrase that I was very careful, I said, was well-intended to address the crisis. So the provisions that are in Dodd-Frank that are intended to address the crisis go into two other buckets. One is well-intended and working well, and the other bucket is well-intended but not working so well. And so these three buckets are sort of where I can think of, like, this is how we think about the provisions of Dodd-Frank of where we're likely to go forward, either at the legislative level for the future of regulation in terms of them coming out with new legislation, or at the regulatory level for us sort of addressing some of these issues. Now, in terms of intended to address the crisis, what do I mean by that? Well, there's a provision in there that deals with the too-big-to-fail banks. Right? And so there's things like heightened capital requirements in banks. So banks fail because the value of their assets go down to the point where it wipes out all the equity, and then you're insolvent. So one of the things to address the crisis was heightened capital requirements, particularly on the bigger banks, so that it decreases the probability that they're going to go insolvent. Other things related to it is less reliance on short-term debt. Right? And when you have a liquidity crisis or a financial crisis, a lot of them is about the inability of institutions to roll over that debt and keep funding what they're doing. Other provisions address the asset side of the balance sheet of banks, where it was, well, you got a lot of volatility on that side of the balance sheet. We're going to do things to make sure that you have not only more capital on that side, but just even prohibit certain activities. So things like what's called the Volcker Rule, that now banks are prohibited from engaging in proprietary trading or investing in hedge funds or private equity funds that engage in proprietary trading in an indirect way. So those are some of those issues that were addressed on there. Some of the other things that were intended to address the crisis was that it turned out that the regulators and the government writ large had no idea what the true exposures of large institutions, complex financial institutions like banks, investment banks, and everybody else in the economy, in terms of what their real net exposures were to each other. We had some data on some loans, we had some data on other types of things, but we had no idea of this huge, huge market, which is called the over-the-counter derivatives market, which is literally hundreds of trillions of dollars of exposures. Think, for those of you in finance classes, the swaps market. So interest rate swaps, currency swaps, foreign exchange swaps, credit default swaps. So these are payments that depending upon the performance of some index, one institution makes payments and the other receives the payments, and the government really had no idea. This is why AIG failed, because they had written swap contracts on the one side betting that the housing market would never fail, because why? These were all AAA rated securities, right? What's the likelihood that the entire U.S. housing market would all go down at the same exact time? Well, it did. And it turned out they owed a lot of banks money, and these banks wanted the money, and they were in dire straits themselves. One of the things Dodd-Frank did was it got rid of, there was actually a prohibition from this market being regulated, actually. There was a law that was passed that said none of the regulators should be able to see this, which was kind of odd. So got rid of that provision and provides regulatory transparency to us and the CFTC, another regulator in DC, so that we can at least see what those exposures are. Does a lot of other things in the swap space, but that's probably the one that most addresses the crisis. So now, if something happens, we can see what those exposures are, what the net exposures Also encourages them to go through clearinghouses, so instead of having bilateral relationships, you have members of a clearinghouse which is well capitalized and try to get rid of the spillover effects. A number of other things in Dodd-Frank intended to make sure it never happened again was the over-reliance on credit rating agencies. I mentioned these AAA-rated securities, supposed AAA-rated securities. Well, it turned out there were a lot of regulatory incentives for banks to hold AAA-rated securities. It turns out when it comes to your capital requirements, how much equity financing you have to do, which is more expensive than debt financing, the higher rated the security was, the less equity, the less expensive capital you needed to have on your balance sheet. And so what that did was created a lot of incentive to create AAA-rated securities, right? For those of you not in finance, if you've seen the movie The Big Short, it does a pretty good job explaining this sort of thing, where you have all these different complex securities based on mortgage-related assets. People call them AAA, they're not really AAA, and it turned out not only that the credit rating agencies were wrong, but there was an over-reliance on the credit rating agencies, not only by banks, but also investment advisors and other people that were making investment decisions. There was an over-reliance on it. So one of the things Dodd-Frank tried to do in the credit rating space was decrease that reliance. So one of the things is the government agencies, we had written into our rules basically blessing credit ratings in terms of capital requirements and investment guidelines and all those other things. So unintended consequence was we were blessing credit ratings as a way of thinking about creditworthiness. People were outsourcing their fiduciary duty and not paying attention to it, and there was an over-reliance on these. So there's some things in Dodd-Frank that are trying to get rid of those provisions. And there's a whole host of things. I can talk about other things in Dodd-Frank as well, too. Now, I mentioned of those things that are trying to address the crisis, some are well-intended and working well. Some of the credit rating ones, and for example, in that space, taking it out of our rules and regulations and replacing it with not blessing their credit ratings is working well. In that second bucket of well-intended but not working well, this is the big discussion that's going on right now in Washington, D.C. in terms of how do we, quote-unquote, fix Dodd-Frank. Right? Then there's that third bucket, which has nothing to do with the financial crisis, and there are a bunch of us in D.C. that say, look, we just need to get rid of these things, and we need to get Congress to repeal them. If we can't get Congress to repeal them, then we're going to try to do all that we can to lessen the burden on the companies that are subject to these things. And so that brings us to today in terms of where are we going forward, what's the future of financial regulation. If I was here a year ago or 2 years ago or whatever, I'd say, you know, what's the future of financial regulation? It'd be summed up in 2 words, Dodd-Frank, right? I mentioned it was 2,319 pages, right? You got stuff in those buckets. Dodd-Frank didn't automatically just start to happen on July 2010. What it did in those pages was told the regulators, us and all the other financial regulators, us, the CFTC, the 3 banking regulators, the Consumer Financial Protection Bureau, the Federal Housing and Finance Association, and all the other regulators to promulgate 400 new rules, give or take a few, right? Of which we were responsible for about 100 of them or on a joint or individual basis. So Dodd-Frank was passed 7 years ago. For the past 7 years, what have we been doing? What I call the Dodd-Frank death march. There's this constant set of just constantly doing, and the rulemaking process of the regulatory agencies is very long. We need to work up to what's called a rule proposal. We need to do economic analysis, talk about the alternatives. Are we fulfilling our statutory mandate? We put that out for public comment. All of our rules are put out for anyone can comment on it publicly, give us more information about how we should change the direction we're thinking about going. Take those in, and then put together a final rule proposal, finally pass that rule, and then on the back end of the rulemaking, provide some additional guidance, perhaps some exemptive relief, interpretations, and all those sorts of things. And so we did the Dodd-Frank death march for 7 years and got about 80% of the way done with Dodd-Frank, which means that we've still got 20% to go, right? Then we had an election. And for those of us that saw that a lot of the stuff in the DoddFrank Act was in that third bucket, shouldn't have been there, didn't need to be there, we slowed that down as much as we could. I took over as acting chairman, as the dean mentioned, in January of this year, and started putting out for public comment what sort of problems are you running into trying to implement some of the things that we already did so that we can think about trying to make those regulations less burdensome moving forward. So some of those things in that third bucket. And we're starting to move in that direction. right? So what's the future of financial regulation in the United States? It's looking at what we were left with Dodd-Frank, what's left to be done or what's already in there, and how they fit into those three buckets. What's well-intended, working well, let's leave that alone. What is in that middle bucket of well-intended but not working as well as we thought? An example of that we've identified is in the credit rating agency space. I mentioned there's a number of provisions that dealt with credit rating agencies. One was very good, ripped it out of our rules and regulations, that's good. Another one specifies how frequently we need to examine the credit rating agencies and what we need to examine. The statute, the law that created it is very specific. It says we need to regulate every credit rating agency every year, and it lists 8 specific things that we need to regulate. Now, at the time when the Senate staffer wrote this, those were maybe the 8 things that were important. But after 7 years of experience, our examiners are telling us, 1, it takes us all year to get through all 8, and so we don't have any opportunities to do anything else. 2, not all 8 of those things are important, but we need to do it to fulfill the statute. And 3, we've identified some other areas that would actually help consumers, help investors, but we can't get to them because it takes an entire year to get them done. So one of the things we're pushing for Congress is a bill that goes through and says, these are the 8 things you need to do, comma, if applicable, period. That's enough to give us the flexibility to learn what we've learned over the last 7 years of regulating credit rating agencies to actually fulfill the mandate of decreasing reliance and making sure that they're fulfilling their regulatory duties moving forward. And I can give other examples of folks have particular interests in particular areas in that bucket as well too. So what we're doing at the SEC and our other regulators are doing, we're working with Congress for ideas for technical amendments to Dodd-Frank. We are working with the Treasury Department and the White House in terms of working together in terms of what we think are areas that should be priorities for us moving forward, right? Today's lecture, it's actually perfect timing. Just about 2 hours ago, Treasury released a report that deals with a number of these issues, right? So quick aside, when President Trump came in, remember there was a flurry of executive orders that he signed, and there was a bunch of these things, right? One of them was an executive order that directed the Treasury Secretary to consult with all the financial regulators to look at ideas for changes to rules, regulations, and legislation in the financial services sector, things Dodd-Frank related and other things, that consistent with what are called 7 core principles. And these core principles are things like ending taxpayer bailouts of large financial institutions, ending too big to fail. Some of them are, another one is effective, efficient, and appropriately tailored regulations. And so that things that fit in that second bucket of what are things that are not working quite well, how can we sort of tailor the regulations moving forward. Another was ensuring that investors have the information that they need and also have choice out there in terms of their investment opportunities. And so we've been working with the Treasury Department and the White House coming up with these ideas moving forward, and that culminated in a report that was released actually just 2 hours ago and is on the Treasury's website. It's actually the second in a series of 4 reports. The first report was in the banking sector. The report released today is in the capital markets, our space. The third one's going to be on asset managers and insurance companies, and then the fourth one's kind of miscellaneous type stuff like fintech and some of the other things that are there. So you can see there specific examples of what are things that we're looking at in terms of moving forward on Dodd-Frank or trying to get rid of the stuff. They've actually come out. We were the ones that helped push this report to the president to make recommendation back to us to encourage Congress to repeal things in that third bucket. And so I've been sort of speaking about it theoretically. Let me give you some specific examples. Some of these are additional disclosure requirements that public companies that are registered with the SEC have to provide that are completely unrelated to whether this information is material to investors or not. So traditionally, the SEC, our disclosure regime was set up in order to provide material information for investors to make informed investment decisions. And that's the lens through which we view these things. What would a reasonable investor want to know in terms of making an informed investment decision? Unfortunately, what Dodd-Frank did was there was a lot of special interest provisions that were thrown in, these ornaments on the Christmas tree, that required public companies that filed with the SEC to include these additional disclosures that have nothing to do with materiality. And the examples that are in the report that the Treasury report just came out with are what's called the resource extraction disclosure, mine safety disclosure, and conflict minerals disclosure. And then there's also something called the median pay ratio disclosure. Now it's interesting, the three of those were put in literally the last night of what's called the Dodd-Frank conference report. So when Dodd-Frank got passed, the way it worked was it went through the House passed a bill. Went through the Senate passed a bill. They didn't match up. You remember the Saturday morning cartoon, I'm just a bill, I'm just a plain old bill sitting here on Capitol Hill, right? What you do, you go to conference committee, the House, and you reconcile the two. And so we had 2 weeks in a conference committee trying to come out with a bill that was reconciled. The last night of the conference committee, people just started sticking ornaments on the Christmas tree because they knew it was going to go through. And in these sections, there's different titles of Dodd-Frank. Title I deals with systemic risk. Title II deals with orderly liquidation authority. How do you take a big bank bankrupt? Title IV is hedge funds. Title VII is derivatives. Title IX is ours. They didn't know where to put these things, so they literally added Title 15 at the end and said miscellaneous provisions, because they literally threw it in at the end. What these disclosures do is require companies to go through public companies that had nothing to do with the financial crisis, to do incredibly burdensome things, to audit procedures, to go through to make sure that they fulfill these disclosure requirements, right? And there are many of us that believe we need to get rid of those because we're penalizing U.S. public companies vis-a-vis foreign companies and also vis-a-vis private companies, right? And so those are the sort of the things that we're going to move forward in that space. The other thing is because we're taking sort of a pause on the Dodd-Frank death march, I call it, and the Dodd-Frank rulemaking, it frees us up to think about what are other things we can do. Returning to our traditional roots, not only us, but the other financial regulators, in terms of discretionary rulemaking, or what are things that we think are important, not some lobbyist or Senate staffer who got something in the Dodd-Frank bill that mandates that we do these things. And we have made a shift away from Dodd-Frank and towards what I call the forgotten part of our mission at the SEC. So our mission is threefold: protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation. People forget about that third part of our mission is to actually facilitate capital formation. A lot of what we do, the policy choices we make, deal with trade-offs between investor protection and capital formation, right? So you got entrepreneurs that want to access capital, offer their securities to the public. We need to protect those investors and put basic requirements on the companies to disclose certain things, right? On the one hand, if we don't require them to disclose enough, investors aren't making informed choices. They're not as protected as we want them to be. On the other hand, if we make those disclosures too burdensome, then fewer companies are going to access the public capital markets, and then nobody's going to get access to those investments at all. So what we're doing is we're shifting towards a more capital formation, pro-growth agenda. And in fact, our new chairman who came in as the new permanent chairman, and he took office in May after I served as acting for 3.5 months, his mandate from the president was move towards a pro-growth capital formation agenda. He met with the transition team after President Trump was elected, before he took office. And he's somebody who's worked on Wall Street for a number of years. He's worked with a number of companies, helped take companies public, and just telling them about what's right and what's wrong with the public capital markets. And when he met with the transition team, they were shocked because everyone had been focusing on the financial crisis and everyone had forgotten sort of what we were talking about before we went into the financial crisis. And it was the fact that U.S. public capital markets are becoming less and less competitive with the rest of the world. We've always been the gold standard, right? We have private companies that want to grow, increase jobs, increase access to capital, bring their products and services to market, would go public at a certain stage in their life cycle. What we're seeing is that private companies are staying private longer, right? Why is that? Some of it is because private capital markets, there's a lot of flow of funds from whether it's European pension funds or sovereign wealth funds or really rich doctors and dentists who are allowed to participate in private securities offerings, and so companies can stay private longer, right? We're also seeing that foreign companies, fewer of them are choosing to list in the United States. We used to be the place where people would come to say, look, I'm a good company. I want to show investors that I'm willing to bind myself to really good accounting standards, really good regulatory standards, and a really good legal framework. So I'm going to list in the United States so that to prove that to the rest of the world. We're seeing actually companies now avoiding the U.S. capital markets for various reasons. Some of them have to do with shareholder class action lawsuits and some other things that are going on. And so when Jay Clayton, who's now our new chairman, was talking to the transition team, they were shocked. They said, you need to talk to the president-elect about this. And those discussions then morphed into him saying to him, look, are you interested in being chairman of the SEC where we can actually try to do some things and move towards that agenda? And that's exactly what we're doing on that. So what you're going to see from us and some of the other financial regulators, but us in particular, is moving to a more pro-growth capital formation agenda without lowering investor protections, right? And we're already starting to move in that direction, right? 2-3 years ago, if I was here, students would say, well, what kind of jobs can I get that are out there? I would say compliance jobs, because DoddFrank just increased the number of regulations. You can go and you can do compliance. And in fact, some people view Dodd-Frank as a job creator, right? It's creating all these nice new compliance jobs, right? What they don't realize is the opportunity cost of those jobs is money that could be spent otherwise to grow the business. And what we're trying to do is shift that, and so that money can be used to deploy capital in a more efficient way, grow businesses, increase jobs, improve the economy, give investors more access to more investment choices that are out there, right? So I mentioned there's a lot of private capital that's out there, and these companies can stay private longer. They can be over $1 billion now, right? The unicorns, right? You heard this phrase, private companies that stay private don't access the public capital markets. And you say, all right, well, that's fine. Why do we care as policymakers that these companies can stay private if they're getting the access to capital that they want? Well, the problem is the average investor can't invest in those companies when they're private. Why? Because the SEC divides the world up into what are called accredited investors and non-accredited investors. And basically, non-accredited investors can only invest in public securities with some small exceptions. Accredited investors are allowed to invest either directly in these private companies, the next Uber, the next Airbnb, the next whatever it is, or they can invest indirectly through venture capital funds or private equity funds or whatever it is, right? Why do we care? Because it turns out, companies, they kind of go through a growth stage, right? And then they kind of mature. Companies used to go public when they were still at that growth stage. So public investors could invest and get access to the returns on that growth part of this. Now companies are staying private longer and accessing the capital markets later in their career. The expected returns are lower, and a lot of them aren't doing it to access capital. It's just a liquidity event for the venture capitalists to get out or their employees to exercise their stock options and those sorts of things. So we have an agenda where we're trying to, on the one hand, make sure that the private markets still work, but on the other hand, try to think about, are there any regulatory burdens, legal burdens, the cost of compliance that we can do that we can lower to sort of tip that balance so it's not as costly, not as burdensome to go public. The Dean mentioned the Jobs Act. This was a piece of legislation that was passed. It was one of the rare parts of bipartisanship in the Obama administration where the House Republicans and the President were on the same page in terms of creating opportunities for entrepreneurs and increased jobs in the U.S. And one of the pieces of that Jobs Act is something called the IPO on-ramp, which took a first stab at this fact that, if you think of burdens of private companies, regulatory, legal, accounting, all these things, if they're at this level and you go public, all of a sudden it jumps up to here. You got to hire a Big Four accounting firm, you got to hire a big law firm, you got to hire Goldman Sachs as your underwriter, you got to hire all these people. There's this big jump up that's here. So they created something called the IPO on-ramp, which said, let's have scaled regulation for what we call emerging growth companies. So if the fixed cost of regulation goes up right away, that is really hard on the smaller companies. So let's do an on-ramp where we allow scaled regulation over time. You don't have to comply with a bunch of things. So there's some exemptions that you have either until you get 5 years out or you get over $1 billion in revenue. You can have scaled regulation. And there's some other things that come out of that. The Jobs Act got passed and immediately like 80 biotech companies went public. And one of the provisions they like is what's called confidential filings. So it used to be when a company would want to go public, they file a prospectus with us, right? And so this is, for those of you in finance know about this, right? It's kind of like your 10K, your balance sheet. Like, this is all the information that we think investors who want to invest need. And then our Division of Corporation Finance review staff reviews that filing, asks a bunch of questions, sends it back to them, and then they file an amendment. And those are publicly available on our Edgar database, and those become immediately public available. And oftentimes it goes through a series of maybe 3, 4, 5 amendments until our staff is comfortable that, look, all the information about this company is out there for investors to make a decision, you can go public. What biotech companies and other companies didn't like was that this could take weeks and months, and now you're giving proprietary information to your competitors. And it was publicly available, right? So how do you balance the need for investors to get this information, but the fact that you can protect it from your competitors so that you can still go public and they don't beat you to market maybe with a product or something? What we do is the Jobs Act allowed for confidential filings, which said that your first filing and all your amendments are not available to the public. They're confidential up until 14 days before you go public. And then once the final one's done, it becomes available for investors to make a decision, but it's not such a quick thing that your competitors can run in front of you. The biotech companies loved it. 80 of them went public. What that says is that little tweaks in the regulatory environment can benefit certain companies. People have come up with ideas for, there are other reasons why we don't have IPOs in the United States, the macroeconomic reasons and other sorts of things, but this shows that there are little things we can do around the edges. One of the things that Jay Clayton did when he came in as chairman, so this was the Jobs Act that created this, and 80 biotech companies, like I said, went public, very successful. Brought in a new division director named Bill Hinman. Traditionally, our division of corporation finance director is a securities lawyer from what I call the Acela corridor, or the Amtrak corridor on the East Coast. DC, Philadelphia, New York, Boston, all fine places, all fine law firms. But hired Bill Hinman out of Silicon Valley. Bill was the one who represented Facebook when they went public. He represented Alibaba when they went public. He's come in as a complete mindset change at the SEC. The future of what's going on in our Corp Fin is we're going to be more collaborative, more efficient, and more transparent to talk to people about what could we do to help access to capital, have access to public capital markets. One of the things that he did was figured out that this confidential filing, yeah, it's great for emerging growth companies, but those are only the smallest of small companies. There's some unicorns out there that want to make use of this. Maybe that's one of the reasons why they're not going public. So what he did was figured out that we could, at the staff level, it didn't even require an act of Congress, we could expand the use of confidential filings no matter what size you are. We could expand it for foreign private issuers, for foreign companies I want to list here. And the third thing he did was expand it not only for an IPO, but what's called a follow-on offering if you do it within the first year. So company IPOs, they don't really know what the price is. They have to rely on the underwriter on Wall Street for this. And for those of you who know anything about the IPO process, that's sometimes a tension process, right? The underwriter wants to get it done, maybe kind of lowballs the company, and so the company ends up leaving money on the table. Not getting the IPO at $10, and all of a sudden immediately pops to $25. Well, they could have IPO'd at $25 and kept that money rather than somebody else getting that money. So how do you balance that? Well, maybe you hold some money back at your initial public offering and do a secondary offering after your stock's been trading for 6 months or 9 months, so you know what that price is and you have a better idea. So we extended the confidential filing for that. Within 2 weeks of us announcing that, we have companies in the pipeline on all 3 of those. We got companies, large unicorns that are thinking about going public, doing confidential filings, working with our staff, foreign private issuers that want access to public capital markets here in the U.S., and then firms that have already done an IPO and thinking about a secondary follow-on offering. Again, it shows that small tweaks that we can do can actually improve access to capital without lessening any of the investor protections that we have. So what we're going to continue to do is do things like that. Now, we have our ideas in terms of what are good ideas in terms of what we think is going to work in the markets. But those of us sitting inside the Beltway in Washington, D.C., right, the government bureaucrats, right, we think we know all this stuff. We don't. So that's why we're taking a targeted effort to get out and talk to as many people as we can to think about what are your ideas? What are impediments to going public? What can you think of that we could do to help entrepreneurs get access to capital and also have investors invest in these public companies? I've been to Cincinnati, Chicago, New York, Silicon Valley, now in Iowa, talking to some folks yesterday as well too. Let's get your best ideas out there and we can try to move forward in that. So you're going to see us start moving more towards a capital formation pro-growth agenda, as I mentioned. And that third bucket of the Dodd-Frank stuff that's bad, we're going to continue until Congress repeals these things. We're going to continue to think about what can we do to lessen the burden on public companies from doing all of these things. We moved forward on something. There's something called the pay ratio, which requires companies to report the CEO pay and the pay of the median worker, right? And the ratio between the two. Turns out the way the law was written and the way the SEC promulgated the rule, which I dissented on, I voted no, I thought it was a stupid rule. but it actually went through on a majority vote. It's really costly for firms to go through and identify who that median worker is. You think, well, how hard is that? Well, think of a global company that has employees all over the world, seasonal employees, franchises, part-time workers. How do you find what the median worker was? The way the rule was written, it was really difficult for them. So what we did was I opened up a public comment process when I was acting chair to say, tell us what additional burdens you're running into that we didn't know about. They came forward and said, look, it would be easy if you could let us use like internal tax systems or accounting systems we already have, don't make us do all this additional stuff. It would lower the compliance costs and it wouldn't affect the number much, if anything at all. And so we went out with some regulatory relief that allowed companies to do that, right? Again, lessening the burden if you're a public company, thinking about the competitiveness vis-a-vis private companies and public companies as well too, okay? Why don't I stop there? There's about 15 minutes left. I got a ton of other things I could talk about, but what I want to do is hear from you all what things you're interested in. You know, why did the SEC do X? Why did we do Y? Why aren't we doing Z? Why, you know, what's going on that you all I think is important? Yeah. Yeah, thank you for bringing up something very awkward. Thank you. The first question, I knew it was coming, is the first question. All right, go ahead.
What is the SEC doing to...
Yeah. Yeah. So I should give some background. So for those of you in the back that didn't hear this, right? So our chairman went public with a statement saying that our Edgar database had been compromised in 2016, right? What does that mean, right? So when the new chairman came in May, he put cybersecurity as one of his top priorities in terms of what are the things that keep us awake at night is cybersecurity. We get a lot of public and non-public information at the SEC, so we need to make sure that we are locked down on, you know, making sure that we don't have these intrusions. Immediately upon coming in, he initiated a review of our cybersecurity. In the context of that review, it was found that there was an intrusion in 2016 into what's called our test environment for Edgar. So Edgar takes a lot of filings in, public companies, mutual funds. There's an environment where it's like a test filing where companies can say, it's my first time filing this new type of form. Let me make sure it gets, you know, it goes through maybe a day or two earlier than when it's due, so I don't run into any problems. What we found was that there was some software on that test filing thing that was compromised, and folks were able to get into that. He immediately informed Commissioner Stein, the other commissioner. We're down to 3 commissioners, supposed to have there's 3 of us. Immediately informed us. We didn't know about it, and then turned around and issued a public statement on it. I immediately issued a public statement saying, look, I commended him for doing the review because that's how we found the thing. This is how I found about it. And 3, we need to do a full investigation. I agree with him. He announced we're going to do a full investigation. We're actually doing 2 investigations. One is our Office of Inspector General is going to do an investigation. So Inspector Generals are sort of independent sort of people that kind of look at waste, fraud, and abuse and do audits and investigations. They're going to do an IG type review and do whatever they need to do. And those usually take a long time because they want to be very thoughtful and thorough, right? Our chairman said, all right, that's going to take a long time. We need to make sure there aren't any other problems and all those things. So we're also going to do our own review, and we have some senior staff people that are looking into that as well too. They're going to coordinate with the IG, but they're going to kind of do their own thing, purposely be redundant, so we figure out if are there any other problems related to that. We're also looking at upgrading all of our cybersecurity initiatives that we have there and sitting and doing all that stuff. So there's a number of things that we are doing. People are taking advantage of this on the outside, saying, oh, that means I shouldn't have to file with the SEC, or there's these new data requirements. You need to. We're trying to say, look, right now, for what we know, it's very narrowly focused on this one particular area, but we want to make sure that we're clear on this. And so, he's unfortunately had to testify in Congress on this twice. And people say you need to up your cybersecurity, and so he took the opportunity, quite rightly, to say, look, when I come back for a budget request from Congress, we're going to ask for additional dollars for cybersecurity measures to make sure that we can improve in this space. So thank you again for bringing up that awkward situation. So good. Yeah, Bill. Yes. Right.
How has that impeded your mission? Because you're up here saying
Yeah, it's really challenging, right? So one of the things that we have is it's quorum requirements, right? So it means that what's the minimum amount of commissioners that have to be available to participate in certain things? And the two big things we do are rulemaking, which is kind of like a mini legislature. We promulgate rules and stuff, but that's every few months we kind of do this. The other is weekly closed commission meetings where we vote on enforcement actions, and that's probably the most visible thing for investor protection, right? So it's challenging. All three of us have to be there. We have a quorum requirement of 3. All 3 have to be there for us to vote. And so it's really important for us to all be there, right? It makes it difficult to try to take vacation, makes it, oftentimes if I travel and stuff, we have to get a secure environment to participate by phone, or I walk into one of our regional offices and do all that stuff. So it is challenging that. In fact, we were actually down to 2 commissioners. So when President Trump took office, the former chair resigned from the prior administration. They left 2 of us, right? I was the lone Republican, so they were stuck with me as the acting chair, which was fine. Quorum requirements when there are 2 people is 2. Now, there's this thing called the Government and the Sunshine Act, which was passed after Watergate to provide more transparency into the government. And what that says is that a quorum of the commission cannot meet in secret, in private, outside of an open meeting, to deliberate on policy issues for the American people. So what did that mean? Commissioner Stein and I were literally prohibited by law from speaking to each other about policy decisions for 3.5 months. That created challenges. But we knew that was coming. After the election happened, we knew what was going to happen. The election was in November of last year. The president didn't take office till January 20th. So we basically had November, December, and part of January to start. So we met as much as we could to think about what are ideas that we could put forward that are bipartisan ideas, right? I have my set of ideas, she has her set of ideas. There's a Venn diagram where we overlap. What are sensible things that we could do to show that we can function, right, in the swamp of Washington, D.C., a Democrat and a Republican, to move forward on things? And so we met in earnest and we teed up a bunch of things. When I took office in January 23rd, I was able to direct the staff to start working on these things. Some of them were kind of a big deal. So the settlement cycle, so if you buy and sell securities, right, and you push that button, you get today's stock price, but it actually doesn't settle into your account. Up until last month, it took 3 days. We finalized a rule that shortened that settlement cycle to 2 days, basically catching up with the rest of the world, right? Another one we did was, when you go into Edgar filings, and there's a lot of information in there, but there's some things that can be what's called incorporated by reference, which says that, like, your bylaws don't change, your charter. It's like incorporated by reference. We did this filing, 20 years ago. Basically, good luck finding it on Edgar. One of the rules we moved forward with was that if companies incorporate things by reference, they now have to provide a hyperlink, so that all you got to do is click through and find that, right? Not earth-shattering, world-changing type stuff, but I can tell you, senior administration officials who've worked in the private sector said, that's a really good one, right? T+2, yeah, that's fine. But hyperlinks within Edgar documents so it can actually move stuff around, that's like really important stuff. So it does provide, there's a lot of challenges, right? The other challenge we're facing is a hiring freeze and a flat budget, right? So we've had a flat budget from Congress, and there's sort of automatic increases that you get, cost of living adjustments and that sort of stuff. So that means we've had to cut things like information technology and some other things. That's where the real challenge comes for us, is that. So, and not filling positions and backfilling and that may have, if this continues, that could make things a little more challenging, but we're trying to do the best we can. So, yeah.
How difficult is it for you guys to work across the aisle to try to keep something you guys might feel in the best interest of the country, but some people on the other side do not?
Yeah, no, I mean, so Commissioner Stein, the Democrat who's been with you, we worked together in the Senate. She worked for Senator Jack Reed on the DoddFrank stuff, right? And some of the stuff, right, you can tell I don't really like that bucket that stuff that shouldn't be there. And then there's well-intended stuff that actually we want to work together. Commissioner Stein and I worked together on a lot of things at DoddFrank, on the derivatives issues, have built up a lot of respect for each other, a lot of confidence with each other. We know that some things we're not going to agree on, and kind of it is what it is. We're able to set that aside. And then it's like, hey, what can we work on together to try to get things done? Shortening the settlement cycle was one that we had identified a couple years ago. And in fact, I told her, I said, look, we need to show that we can actually work together. It's easier for us to retreat to our corners and sort of be done with it, right? But let's think about what can we work on together that are sensible things for the markets, protect investors, maybe in the case of T+2 settlement, decrease the risk that's in the system, maybe help with capital formation indirectly and stuff. So we make a conscious effort to do that. We meet quite regularly. Now that we're allowed to meet again for 3.5 months, we literally couldn't go to lunch together. It was bizarre. But we meet together, we talk about our kids and stuff for about 15 minutes, and then we get into policy issues and try to figure out what are things that we could do to sensibly move forward. The commission, the SEC, a lot of the regulators are set up as commissions to try to get bipartisan basis, right? So the way the statute works is the president can only name 3 from his own political party. The other 2 have to come from another political party. And so I was originally appointed by President Obama for one of the Republican seats, right? And so we're set up as a bipartisan board, and it sort of forces us to work together to achieve some of the issues. Sometimes we go 3-2 votes, but most of the time we try to make it as unanimous as possible. On the investor protection issues, a lot of the enforcement cases, I think the statistics are we agree like 99% of the time. Sometimes there's little minor things around the edges that we disagree with, but we're able to work on that. So, we try to keep tweeting at a minimum. And we try to just move forward and try to keep things as good as possible. So, although if anybody wants to take pictures and tweet it out and stuff, I'll forward it along. I have 387 followers, so you get big people reading and stuff. So yeah.
Like an interesting article I read with regard to enforcement action was, in essence, that someone should go to jail before there would be an enforcement action, so that it wouldn't be a, hey, you know what, this is just the cost of doing business, it's less than the money I paid. Would you like to comment on that?
Yeah. No, so I know there's a lot of confusion. First of all, we can't put people in jail. We only have civil authority, right? It'd be kind of cool if we did. Make them do the perp walk, right, with the handcuffs and all that stuff. Wait, so we have civil authority, which means that what can we do? If there's a security law violation and there's what's called ill-gotten gains or illicit profits, where people earn higher fees or those types of things, we can disgorge those, get those back. We can also assess penalties if we think it's particularly egregious, or if they try to hide it, or we're not working with us to try to mitigate the thing. We can do those. We can bar people from the industry. We can censure firms so that they no longer are in the industry. Not only if somebody commits a crime as a broker, we can do what are called collateral bars. We say, no, not only are you not allowed to be a broker, you can't work for a credit rating agency, you can't be a muni advisor, you can't be an investment advisor, you can't do all those other things. Certain types of fraud that we uncover, there's some criminal intent or criminal fraud things. We work with the criminal authorities. So we work with the Department of Justice, the FBI, and sometimes coordinate cases, right? And sometimes there are cases that we're working on, and all of a sudden the FBI says, yeah, we're going to arrest the guy, so we need to get a filing ready together and file in court to go after the person. So some of them are just civil, and some of them are civil and criminal. Sometimes we find out that the criminal authorities have worked on something that we weren't aware of. We can do a follow-on proceeding. They're already in jail, and we're going to, when they get out of jail, we're going to bar them from the industry and those types of things. But your point is well taken. There's this palpable sense from a lot of people, both on the political left and the right, that nobody went to jail for the financial crisis, right? And it's just like, why didn't anybody go to jail on this thing, right? And I get it, right? And that is actually driving a lot of the politics in terms of what's going on in potential for other financial reform that's going to go forward on this. Maybe increasing the penalties or trying to make it easier to criminally prosecute individuals and those certain things, yeah. Yeah. Mm-hmm. Yeah, so the questions for those of you who didn't hear in the back, if by moving to the capital formation agenda, swinging the pendulum, is the opportunity to lessen the investor protection? The answer is absolutely yes. And so we're very, very conscious of that. What can we do to not lessen the investor protections in this space, right? The other thing we're very, very conscious of in the broader sense, not just the capital formation, but the fixes to DoddFrank, there's been a certain level of resilience that's been built up in the system, whether it's higher capital for banks, less reliant on short-term funding, higher margin requirements if you do complex derivatives trading. So that what it does is it requires, if there's daily fluctuations in the price, that we have to exchange money back and forth, so that if in the event of my default, you've already got most of the money in your account minus the next day or that sort of thing. there's a resilience that's built up in the system, and we're taking a better look at it. People are calling it efficient resilience. How do we decrease the burden on these things without lowering the level of resilience? And my argument is, I think we're going to actually increase the level of resilience, because a lot of things in Dodd-Frank were done with blinders on and have sometimes at cross purposes. And so when we take a fresh look at these things, I think we're going to end up with a more resilient system. And back on the capital formation front, we're always worried about those things. What's information that investors that need, right? And then on these disclosures that they don't need, not only is it just making the documents bigger and bigger, it's information overload. Some people just look at the size of these documents and go, why even bother reading it? Or, I can't find the information that I want in there because there's all this stuff that's in there. And so by actually going through and trying to make these more efficient, more effective disclosures, I would argue we're getting better information out to investors and can actually increase the investor protection. But it's something we're always attuned to. Yeah, one more. Any? Oh, yeah, there you go. Yeah, so the question is the Financial Choice Act. What the Financial Choice Act is the House of Representatives, their first stab at reforming Dodd-Frank, right? And it kind of has things that are working well, they leave alone. Things that there's regulatory tweaks, things like the as applicable language that's in there, things that they think should be repealed are in there as well too. And I think it's a great act. Now there are people that will disagree with various things. There are other provisions in there that that take away this what's called orderly liquidation authority, which is how you resolve a large financial institution, and replace it with language that would amend the bankruptcy code. So it's an alternative. So there's a bunch of stuff in there that I think is great. It passed the House largely, or maybe exclusively, on partisan grounds, right? And the Senate doesn't look like it's going to take it up anytime soon. But the Senate will at some point take up certain Dodd-Frank reforms that it thinks it can get through and at least get some Democratic votes, because there's only 52 Republicans and most of the time they don't agree anyway. They need more Democrat support for this stuff. So what the House is going to start doing is taking pieces of the Choice Act that have garnered some bipartisan support, or they think they can get some bipartisan support, and they're going to start to pass those individually and see if they can get bipartisan support for sensible reform, right? So let's take off the table the ones that are politically charged and at least try to get something through in this. And so you're going to start to see those start to pass the House, and then at some point, it probably won't be until next year for the Senate to start take this up. So it's going to take a while, because the Senate, the tax reform, infrastructure, budget, and a bunch of other things. So we'll see that play out over the next coming months too.
Well, Mike, thank you so much for being with us today. That was a wonderful talk.
Thank you.
And
thank you. Thanks. Ready. Let's see.
Mike doesn't get back to Ames often enough, so we have a picture of a book about the Four Seasons here at Iowa State for you, Mike.
Yeah, I was just asking about the swans, if they're still there. Don't run over the swans.
Thank you all. Thank you, Mike.
Thank you.